Okay, welcome everyone. This is our first meetup / presentation of the year. We're going to do we did a recap in December about 2024. We're going to talk today about, it's a bit of a market forecast and then also just some commentary of everything that could and might happen and some of the strategies moving forward. Okay, so the things that I look at and have always looked at since I started in real estate, which has been about 18 years now, these are the things that I've always paid attention to. So economy and jobs, obviously, that has an impact on real estate because the stronger the economy, the more jobs, the more immigration, the more eventual household formation. It ends up impacting the price of real estate. Then there's, of course, the immigration has two components to it, the international component as well as interprovincial. We've seen Calgary have some pretty significant interprovincial numbers. We're going to talk a little bit about that. That is likely, or some are estimating that's going to slow down. We feel that that's probably not going to slow down as much as some of the economists are thinking that it may slow down. We'll see in some of the projections. I just think that Alberta's economy is going to be doing so well, and that's going to be contrasted by the economy in central Canada and really the rest of Canada not doing very well at all. And I think that especially Ontario, things are going to get pretty challenging economically, and people are going to be coming here looking for work. So with jobs and economy, immigration, which is demand, and then the supply and demand. So the jobs and economy are both medium and long term. Immigration is kind of a short, medium term, has short and medium term impact, but relatively short term. Supply and demand is about as short term as it gets. So that would be things like how many houses are being built for how many people or household formations, and we'll have some information regarding that as well. That's one that's when I say short term in real estate, that's 12, 18, 24 months. And then the underlying one that most people don't watch that I watch is this affordability. And this is how much incomes are compared to housing. So how much of the average income someone spends on housing. This one is extremely long term, but it still impacts the market. It is, if you look at a market where real estate prices are going up at 10% a year, but incomes only go up at 2% a year, eventually the math stops working. So eventually we'll have to get back to a median. And that works in reverse as well. So here's an example of where things were in 2019. This is denominated in US dollars. In some ways you can almost ignore the dollar numbers. Just look at the colors. Calgary is right up here. In 2019, this is what this number is from. Again, denominated in 2000 US dollars if you're looking at the dollars. We are the most affordable city in 2019. We were the most affordable city when you can compare incomes to house prices. Now, if you looked at 5 years prior, it was about the same. If you looked at 10 years prior, things were still about the same. So in 2013, 14, 15, when you asked me about these numbers, I thought, okay, well, Toronto's overpriced. And it was. Where is Toronto in here? This map is hard to actually follow. But Toronto, I think, was number 11. I think Vancouver was number 2. Yeah, there it is there. So Toronto was number 11, overpriced significantly. But you'll see in the subsequent 10 years, Toronto went up another 116%. This is just the last, so this includes the pullback in prices recently. This is the last 10 years of increases in real estate prices across the country. So going back to this kind of long-term number, why I like to look at this number is it gives an underlying fundamental. What made me comfortable in 2019 when cash flows had been flat forever, I was stuck in real estate that really hadn't moved in prices in 15 years since I'd bought it, or almost 15 at that time, is that I knew that there was some underlying fundamental, like the underlying fundamentals were there, and that there was the capacity for prices to go up significantly and still be very, very affordable. So if you look at, so during this period, prices in Toronto in 2007 and Calgary were always almost identical. We'll go from Vancouver was always number one, number two was always Calgary versus Toronto of who the second most expensive real estate was in Canada, and that was the early 2000s. And then by 2022, Calgary's prices had just hit par with 2007 numbers, and Toronto had tripled from 2007 numbers. But incomes actually went up further in Calgary. So the affordability numbers didn't make sense. In 2010, I would have said, well, that doesn't make any sense. In 2015, it didn't make sense. In 2018, it didn't make sense. What I did underestimate in all of those years is how long affordability could be out of whack. And as long as supply and demand, supported by everything from government taxes to incentives to consistently lowering interest rate, would support an excessive market. And there's nothing to say that a market that's overpriced can't become more overpriced. And that's what continued to happen in Toronto. But eventually, once something triggered the market to stop supporting itself in a speculation market, which in this case was interest rates, it started to collapse. And that's why you've seen some struggles in Toronto. And I think we're going to see more over the next couple of years. Whereas in Calgary, we're kind of the opposite. Once we finally got the diversification of our economy and all the different industries moving here because of affordability, we ended up seeing prices with so much room to go up because of our income and low affordability. Prices did go up. This 40% is all in the last few years. So this is Calgary here at the 40% increase over the last decade. All of this has happened in the last two and a half to 3 years. This seems, these are again from 10 years ago. If we looked at 15 years ago, most of these would probably be in the 200s because prices were already getting overpriced in 2015. So there's a couple of reasons for this. One is that I think a lot of people are thinking, well, okay, now Calgary's had a big run. Now we're too unaffordable. When's our crash happening? This is still the context that we're dealing with. This is all of Ontario, where people can't afford the houses that they live in. And now a lot of people that bought in 2020, 21, and early 22 bought at peak prices. They took out massive mortgages, and you will see a lot about averages talking about, well, the average mortgage is only going to go up this much. The average mortgage in Ontario is only $295,000, but that includes somebody that bought a house 32 years ago and has a small $72,000 mortgage in it. So you average enough of those out from 65-year-olds about to pay off their mortgage, and it does bring the average down. But the vast majority of people buying in 2020, 2021, 22, those were young families buying with no equity. So they were getting $800,000-$900,000 mortgages. Young families are also the biggest consumers. They haven't saved any money. They need lots of things, everything from travel trailers to taking their kids out to different play places to restaurants so young families don't have money, but they do have a lot of expenses. Whereas old people with the small mortgages, doesn't really matter what interest rates do. Their income and lifestyle is relatively fixed. So the problem that I see is an underestimation by economists of the impact of the largest consumers, and 2/3 of Canada's economy is consumer spending. That's pretty normal in a Western economy. It's even higher in the US. So 2/3 of our GDP is consumer spending. And the largest group of consumer spenders are also young families, and those are the ones with the largest mortgages. So the people that will be impacted the most in terms of having their payments reset over the next few years from a 1.59, 1.74 into a 4.5 interest rate on a $900,000 mortgage, those are the people, they're the biggest consumer spenders, and they're about to have to cough up an extra $1,500, $2,000 a month. It's going to impact the economy there, I think, a lot more than people are anticipating. So that's, I guess, one of the reasons why I think in Alberta, and we have the same dynamics in terms of interest rates, but in 2020, 2021, our mortgages were $350,000, $400,000. So our mortgages are a lot smaller, about half of what they are in Ontario, to buy basically the similar house in that similar time frame. So our increase is still much more affordable for us. This is something I like to, we've talked a lot about this, so you've probably seen us discuss this before, is that all of the new jobs that we've created over the last 5 years, very, very few of them are oil and gas. So up until last year, the big boom in jobs, none of it was oil and gas related. Now, our economy is still based on that. Our government royalties are based on the production of oil. But in terms of new expansion of our economy and job growth, all of it's been in fintech, agribusiness, big tech, big data, agribusiness. De Havilland's moved manufacturing here, which is one of my favorite things to talk about, just because we don't have an aerospace industry and we're not a manufacturing hub. It doesn't make any sense for them to move here. So it must be that when they looked into it, that Alberta is just a good place to do business, and they realized that it was worth the cost of moving here, which is, I think, why a lot of other industries are diversifying. So Anthony's going to talk about, we've obviously got that. It's great for our diversification, but we're actually going to see, because of TMX and a few other things that are happening, our oil industry is actually probably going to come back and add a lot to our economy to increase wages and create a lot more employment as well. But this particularly right here is when oil and gas stopped being the predominant growth driver in our economy, and it was passed by other things, largely because energy dropped off. But if you see what's happened over the last few years, oil and gas has slowly increased, and then we've of course seen the tech industries and tech business, agribusiness, and diversified parts of our economy increasing. It doesn't really look like a steep trend because we see a lot of up and down here, but this is a pretty strong trajectory. And then I think this one could possibly be even underestimated, because oil and gas seems to be coming back pretty strong. And every time we turn around, we're hearing more and more. Well, again, Anthony's I'm stealing all his points tonight. I'll just hand it over to Anthony before I just get carried away and steal all his talking points.
Okay, so yeah, to continue with what Layne was talking about, as you can see, this is a historical and forecast chart from ATB, and it's a forecast of the GDP growth in Alberta. They have three scenarios in there. They have their low case, base case, and high case. The different scenarios are mostly based on what's happening in the US right now. So their low case assumptions are based on if Trump is going ahead with full 25% tariffs on everything, not excluding oil and gas. And we can see that even in that scenario, which in our opinion is quite unlikely, ATB is still forecasting growth, although obviously slower, but still decent growth for Alberta. Their base case is something that's more likely to happen, where we would see some tariffs, but oil and gas would be excluded from those tariffs, which seems to be the consensus right now on what's likely to happen. No one has a crystal ball. That's why ATB still decided to do the three scenarios. And their high case is based on some tariffs, but limited. So it's not even based on zero tariffs at all, but just some limited amount of tariffs. And this is really encouraging because, as you can see, the trends are really good in all cases. Obviously, no crystal ball there, but I'm going to cover later on why there's a lot of underlying fundamentals to support those assumptions that have been made. So I don't expect you to read all these. It's kind of on purpose why it's hard to read. This is all the major projects, at least just the feature major projects that I could find that are happening right now or set to happen in Alberta. As you can see, there's a lot going on, and some of these are quite major. For example, $70 billion potential investment in AI data center for Alberta in Grand Prairie, out of all places. These are really large numbers and not something that Alberta used to see much, especially in the tech sector. East Structure is actually building a $700 million data center in Calgary. Lots of food manufacturing stuff all over Alberta, Strathmore, and close to Edmonton, Calgary. And then the energy stuff, right? So, and that kind of ties in with what Layne was saying, that the forecasts on oil and gas growth are potentially quite conservative because there's actually a lot going on right now, including carbon capture projects and other large, like these are large projects, like, you know, $11 billion carbon capture project in Edmonton. So this is very encouraging, and they are not oil and gas related, which is good to see. But talking about oil and gas, as you can see, even though our spending in oil and gas has not really been growing over the last few years, really since the peak, we haven't really gotten back to what we used to be at. The production is still growing, and growing fairly steady. And that's partly done because of efficiency improvements, and partly because of some expansion projects like the TMX pipeline, which have added some capacity. And onto that point, as you can see, the exports to China, the orange bar there, that's the energy products, so mostly oil and gas. And that's improved significantly. And again, that's TMX going to the West Coast and allowing that. And it's not a lot comparable to what we export to the US, but at least it's an improvement, especially now with the way that the US is threatening to interact with our own gas exports. It's good to see that. I'm going to attract your attention to the little quote at the bottom from ATB Financial, because I think that's really important right now, is that the oil and gas boost that we're seeing right now is mostly through production, which is very different, because the past booms we've seen in Alberta have been mostly driven by expansion projects, right? Where this is very different. And the nice thing about this is, as Layne talked about, we haven't seen huge growth in oil and gas in terms of jobs, but yet we've still seen growth in terms of our economy, right? So there's diversification there. So I'll hand it off to Santhosh. He's going to cover a bit the population growth, because that's something that we're seeing that's changing significantly right now, and that's something to watch for going to 2025. It's going to have a large impact on investments. So,
yeah, onto population growth. So two figures here. So starting with the figure on the left, this one's population growth in Alberta measured in the thousands. And we can see the forecast here. Obviously, we've had a pretty big population growth in the last few years. But what's interesting is net intra-provincial migration. They're predicting that it's going to be going down, but we're actually not too confident. We're not so sure it's going to go down to the same extent that ATB is forecasting. We think if the economy in Alberta we start to see a bit of a boom here, those forecasts we might deviate from that forecast. So that's one thing to note. Population growth is slowing, and if we look at the chart on the right, our year-over-year growth, the government's expecting little to no population growth. We don't foresee that to be the case. We think population growth will still continue, but at a much slower rate. Now, obviously, the breakdowns are going to vary, right? Immigration is slowing down. However, like I said, intra-provincial migrations, I think, going to be a big driver to the Alberta economy in 2025. Okay. Housing growth. So these are housing starts versus formations. So housing starts are here on the orange, and household formations in the blue. And we can see the peak here that we've experienced, and the forecast is saying that housing starts we've seen kind of the peak here, and it's expected to decline. And we've soared to levels not seen since 2007, which is important to note. One more thing I want to highlight here is the months of resale residential housing inventory. So we've seen a peak here. The last peak was May 19 to May 20. And Alberta's housing resale residential inventory has been relatively flat for the most part. And the quote here from ATB is, our forecast is for housing starts in Alberta to total about 45 grand next year and 40,000 in 2026. Overall, home construction is a key reason why we expect Alberta's economy to continue growing faster than the national economy. And we see that with housing starts. We see, if you drive to the suburbs, you can see that happening in place, right? And then housing starts. So this chart here shows you purpose-built rentals versus other, which is all types of housings. So we can see a gradual increase in purpose-built rentals, and this is Canada-wide, so not just Alberta. And we just put this in more as a recap. We actually covered this a few meetups ago with the CMHC Fall 2024 housing report, so we just wanted to put it back in there as a refresher. But you can see Calgary over here, year over year, between 2023 and 2024. It's a pretty big change from the 10-year average. So we're trending well above the 10-year average. Okay.
Just to add to this, and
Yeah.
the previous slide, there's two things too we wanted to point out. The purpose-built rentals, the levels we see right now of building, it's unprecedented
Yeah.
levels, as you can see. Right? Since the chart goes back to 1988, and it's significantly higher by a few folds.
Many
And
magnitudes.
on the rental market side, those are actually completions, not starts. And that blue bar on the 2024 is over double the 10-year average on the completions, but we expect into 2025 that bar would be actually higher because a lot of housing starts
Still under construction. And yeah, actually, just to add to this, with the number of purpose-built apartment rentals, for those of you who own, many of you here own rentals, you might actually notice that already with units taking longer to rent, and rents are starting to decline as well. So you'll kind of see that because we're starting to get a lot more supply on the rental side. So this is just a quick market update of where kind of data from the Calgary Real Estate Board. This one's for the total residential price. So the covers all property types. On the next few slides, I'll show you the breakdowns by different property types. But essentially, our months of inventory is going up. So year over year, we're about 41% higher than where we used to be same time last year. We're about 3.2% higher than where we used to be last year over year price increase. Okay. So these are the breakdowns by row house on the left, townhouse, apartments on the right. You can see inventory is going up pretty quickly in these market types, in these property types. 82% growth in months of inventory for townhouses and 70% increase in months of inventory. Prices are still higher than where they used to be year over year, but the time is now, average days on market is now taking a lot longer. It's about 40 days to sell your average townhouse and about 48 days for a condo. And we see this trend, we think this trend is going to continue. It's going to take longer and longer as more supply hits the market as well. This is likely going to get worse before it gets better. Okay, on to the detached and semi-detached space. So still fairly strong seller's market in both of these property types. We're right about 2 months of inventory. Still higher than where we used to be last year, which is good. Now we're starting to get a bit more supply. That being said, it's still fairly limited inventory if you're looking in the market right now. Okay. Days on market are going up about 25% growth there. And we all know prices are still higher than last year. So about 7% and 8% growth. So we expect that inventory is going to improve in the coming months. It's hard to tell how much and how much of a inventory bump we'll get. But that should help your sales price as well. Ideally, that puts some downward pressure on prices and helps you get into the market a bit easier. Okay, I'll hand it off to Layne, who's going to cover the interest rate forecasts.
Okay, so I almost don't like talking about rates because it's very specific to a circumstance and people have to make a decision on rates. You're buying real estate, it's a long-term thing, and I don't think what today's rates or what's going to happen in the next 6 weeks, Bank of Canada meeting, they meet every 6 weeks, is all that relevant, but people always ask. So here's kind of what's happened over the last many number of years. Obviously, we had the COVID drop, and then we had a pretty big spike to combat the inflation that was a result of a lot of money printing, as well as the Bank of Canada participating in the bond market. And this is about where we're at now, and where the most economists are predicting another 75 basis point drop. I think I believe that things are going to be a little bit worse, as I already alluded to. I think things in Ontario are going to be a little bit worse. And Ontario happens to be where all decisions are made with regard to banking in our country. All the major banks are there. The Bank of Canada beats there. It is also by far the largest population. So that's who makes the decision. If Ontario is doing bad, they're going to drop interest rates. Even if we're overheated, they won't care that we're overheated. If our real estate prices are skyrocketing and inflation's crazy here, they don't care. They don't need to slow our economy down. They're only going to focus on Ontario. So I do believe that. So no one's calling for this. No economists or anything are calling for this. But I think the Bank of Canada will participate in the bond market again and do more what they call quantitative easing. So I think both this could come down. This is kind of the agreed upon consensus, or kind of the average of what most economists are saying. I think it could go a little bit lower, though this is still possible. And I also think there's a possibility that fixed rates continue to go down a little bit as well, or end up going down. Right now, they've hit about a kind of a natural bottom of where the fixed rates are, because those are based on the bond market. And the bond market has really stopped moving, even over the last couple of quarters, or at least quarter, as the Bank of Canada rate comes down. So, which does leave you to say, if you're waiting to lock in, it's almost worth considering now finding out what your bank will lock you in at. And so if you took a variable with the intent to eventually lock in, now is as good a time as any to do so. And again, come talk to me if you have more specifics around your circumstance and why you might want to do that. So, so inflation dropped over the last year from the high of 8 down to 2%. That 2% is a manipulated figure. It's probably 4.5. They just call it 2. And the Bank of Canada lowered rates 1.75 basis points from 5 to about 3.25. That is the bond rate. That put the actual bank prime lending rates, put it from 7.2 down to 4.45. So if you're getting a line of credit, for example, secured on real estate, you would have had a 7.7% line of credit, and now it would be 5.95. And if you had a variable with a 1% discount, it would have been 6.2, and it would now be 4.45. And again, likely still to come down if you're actually comfortable riding out a variable rate. The difference is pretty significant just in this 1.75% drop. If you have a $500,000 mortgage, it's $87.50 per year, about $730 per month in interest. Now, you won't have seen your payment drop by that, because part of that actually just increases your principal pay down on every monthly payment. So this is what I've already discussed. Economists are guessing that the overnight lending rate will end up at 2.5, which will leave the bank prime at 4.7. There's been a couple of CMHC rule changes. One of the ones that's going to happen, the stress tests, or this one is on January 15th. So I think a week from today, we're going to see this one implemented. So spring of this year, they implemented a change where for new properties, if you are getting a new property and you're a first-time buyer, you could get a 30-year amortization on an insured mortgage. So putting less than 20% down through CMHC. They've changed that to instead of and, so requiring to meet both of those to actually qualify for that. It's or. So if you're either a first-time buyer buying any property, or you're anybody but you're buying new, so that's supporting the market essentially, which is kind of funny. They're fighting inflation they're fighting an affordability problem. Things are too real estate's too expensive, so they're making it easy for real estate prices to go up. As silly as that is, it supports those of us who are real estate investors. And then the stress test. The reason I mention this is because there is a stress test for mortgages that is they implemented maybe 7, 8, 9 years ago, prior to all of the COVID and the interest rate increases. But the stress test was that you had to qualify for at least 5.25, or whatever the interest rate you're getting plus 2%. That's the rate you had to qualify at, basically to offset in case rates went up, which was probably a prudent decision. They're removing a stress test for switches and transfers. So people hear removing of a stress test to think that that doesn't happen, that nobody has to qualify for that anymore. The only thing it matters for is if you're renewing an existing mortgage and you want to move from Scotiabank to TD or vice versa, you're not getting any new money. You're just taking the exact mortgage, the exact amortization. You're taking it from one place to another. You don't have to qualify with that stress test. So they're just making it easier for competition. It was considered anti-competitive to basically have a lender that's kind of got you hooked in. You can't qualify for someone else. They're not really going to offer you their best rate because they know they don't have to. So they removed that for a very small subset. That doesn't mean the stress test is gone. So if you're hearing about that, it's not as good as it sounds. So this is the risks and variables and black swans, which is, a true black swan means you can't even predict it. So it's pretty tough to predict those. But Trump tariffs, this is the one we're pretty concerned about. Energy will almost certainly not be included. It's possible it would be included for a short term as a negotiating tactic. But the way that futures are traded in the energy markets is if tariffs were even announced, the futures would change. Gasoline prices in all of the swing states, which is where a lot of our oil and gas goes to the refineries in the swing states like Pennsylvania, that what used to be considered the Democratic blue wall that Trump won over, immediately gas prices would skyrocket in those places. So his number one campaign promise was to lower energy prices, and within a week he'll skyrocket energy prices if he actually put tariffs on Alberta energy. So likely it would be omitted. If he's willing to use some political capital to put it in place for a couple of months because he thinks he'll benefit from some other negotiating down the road, it's possible. But they buy our oil at a discount, then they refine it and sell it on the world market for a profit. It is a very big net benefit to them, short-term, long-term, everything. So it's just unlikely. It wouldn't be good for them, nor would the optics be good. So I just can't see that lasting. I just don't think it's possible that would last longer than a few weeks, and unlikely to even start. But we'll see. We'll see in a couple of weeks. So again, I just don't think that'll have a huge negative impact on us. Keystone, other pipelines. Keystone, Trump will probably overturn if someone wants to build it. I don't think there's a big desire because we actually have enough egress to get our oil out now. So Keystone may not go forward, but if we wanted it to, he would certainly be on board. He's already alluded to that. That would be a big win for us because we could aggressively expand oil and gas output again, without worrying about, we'd have decades before we'd have to worry about kind of our oil being trapped after we produce it, which we've dealt with for a few years. Canadian federal elections. I think the outcome is a change in government, but how that looks, the impact it's going to have, I think largely it's good because the current government's been shutting down both the energy industry, but also major infrastructure projects. A new government that's going to encourage investment back into Canada is a good thing, probably more specifically again for Alberta. But also it's a federal election. We don't know the outcome. So it could just be a lot of uncertainty, which is not something investors like. This one's a big one. For years, the biggest investment banks in the world stopped investing in fossil fuels. So their ESG stuff, they had basically just put a moratorium on investing in fossil fuels. They would do wind, solar, but they did not do any kind of big oil sands projects. That has, over the last 4 or 5 weeks, maybe it's Trump, maybe it's because the returns that they have missed out on are something that they wish they hadn't, but they're systematically, every week we hear like Goldman Sachs, I think BlackRock's out now, so they've just said we're ending our ban on investing in fossil fuels, so big projects and infrastructure for oil and gas, which is something we need to develop our oil and gas. Fracking, for example, doesn't need massive investment banks in the US because it's really inexpensive to drill for fracking. Now, you don't get much oil out of it, but you get it right away and it doesn't cost that much to drill. Our projects take a decade to build and $10 billion. So we need, when we're building infrastructure, it needs big banks to help us, and that was cut off from us from years. So another, again, potential bonus for us as we see oil and gas, actually a bit of a resurgence in oil and gas. For us specifically in Alberta or in Calgary, there's going to be an oversupply of rentals. We have market's done what it's going to do. This is short term, but Anthony alluded to it, kind of showed up in the stats there. We're just getting a ton of multifamily. It's all going to hit the market in the next year or so. If you think that, because I've seen stats saying that, prices are going up at 26% per year. So don't go buy a rental thinking rents are going up at 20% next year. They're likely to go down. I'd say they've probably come off the peak about 10%. That was a short-lived peak. So if you last rented something 2 years ago, you're still going to be renting for the same or maybe even more. But if you rented 8 months ago when there was no supply left and you got a maximum rent, you're probably not going to re-rent that for that amount. And if you tried to rent it right now, it's a bit seasonal, but it'd be 10 or 15% less than that. So again, if you're looking from a 2-year time horizon, rents are still strong. But if you just rented something for a peak amount, you're probably going to end up losing rent. So I think rents are going to be flat. Actually, I wouldn't say flat. I'd say probably 10% from the peak, or maybe stabilize at where rents were 2 years ago for 12 to 18 months. So don't buy something with a speculative rental amount in mind. Look at what the rents you are and maybe make sure you've got a little bit of cushion built in as well for 18 months. Again, these are risks and variables. These are things we don't know and this is something that if we have strong population growth, that might not even matter. But these are things that we basically can't predict, but are worth keeping an eye on. OPEC is always a risk or variable. Yes?
I have a question about the rental rates. So as a mortgage broker, are you noticing on the MLI Select projects where they basically projected what the rents are going to be, and right now if they're renting them out, they're probably not getting those rents.
Yeah.
What do you see happening with that?
So first of all, yeah, they're definitely not getting that. They're already adjusting. They've already dramatically adjusted what, like CMHC is now saying, no, we're projecting rents at a lot lower. It's theoretically possible, depending on how they got their financing. But if they've built it, it's possible that there's going to be a cash call at closing in order to get Well,
CMHC changed their rule now, and they are only advancing 75% loan to value
on new projects. Yeah,
on new projects until you prove your rents, right? Until you achieve your rent. Yeah. So you have to lease them up, or
yes.
Exactly. And
so
we do forecast those might come up short. I mean, there's still performers right now that they're completely unrealistic on the rents.
Yeah.
Do you do CMHC MLI Select?
No, and and we were going to do it on our own project, and we essentially backed out of it, largely because it was so successful that I think there's an overbuild of them, and it's put them at risk. That we're going to get thousands of 410 square foot 1-bedroom basement suites, all congested in a few neighborhoods in the city. Those rents are going to crash. That is not going to be healthy for that subset of the market.
But I think it's going to get worse before it gets better. Right?
Exactly. Because you're at 95% financing and a very long amortization, your cash flow could quite easily go negative for a couple of years on those for people that may not have a lot of reserves. So I didn't like that. The corrections they've made. So they're basically saying you either have to pre-lease it, but no one's going to pre-lease a rental for 2.5 years from now. So unless you pre-lease your condos and get signed leases from a bunch of people that are going to rent from you in 2.5 years that are at a pre-described rent, what's going to happen is you have to come up with a 25% down, and they'll only top you up to that 95 once you've completed the project and rented out a certain amount of the units, and you've actually proven that those rents are accurate. So I think they did what they had to do on the MLI Select, because I think it was a very dangerous product up until that point, which we've discussed a little bit before here, because it was almost too good, especially in Calgary.
So, that was my question. So what's the duration of that in the guy track, we're talking about be at LTV to 75% for like 1 or 2 years of rents.
No, it's until you rent the property out. So during construction. So if you buy a house, tear it down, you have to basically complete your construction and rent out. How many units is?
I mean, technically, if you pre-lease your entire building and you achieve the rents that you qualified with, you could get the 95. Yes. Yeah, exactly. So if your rents are lower, then they'll adjust your DCR by giving you less loan to value, right? So, or they'll release it once those units are rented if you don't rent them in time. So,
yeah,
but it's hard to pre-lease an entire building at the rents that you got approved for before it's even built in an environment where you have a lot of competition. So, yeah.
Yeah, it's just people don't lease like that. Like people buy like that, especially in a speculative nature, but people certainly don't lease like, oh, where am I going to rent? Well, we could rent over here. We could rent this main floor here. We could rent a townhouse here. Or in 2.5 years, we could sign a lease that we'll get that in 2.5 years.
Or even if it's in 6 months or whatever, like the tenant don't get to see the unit. It's tough. Yeah.
Yeah. I mean, yeah, technically, I guess if you're building a larger project, you might be able to finish out one phase pre-lease from another from a year from now. It's possible you could get it a little earlier than completion, but you largely have to have 25% to get, you basically have to have 25% into the project to get it complete or be pretty confident that you have access to that amount to have completed it. So, and again, I think was desperately needed change, and it's really made me a lot more comfortable with that product. Back to black swans. There's everything could kind of change it, but I think we're largely done. Oh, this is something that I talk about a lot, is inflation, because in spite of the fact that we're talking about like some short term, like, so if you have to drop rent on a unit, if you got 2 houses and you got to drop rent $300 per house or $350 per house, okay, so that's like a $4,000 cost for a couple of years on every house you have. But largely the overall fundamentals are that Alberta's and Calgary specifically are set up for some pretty strong growth in a lot of ways, especially when you compare it to the rest of the country. So I'm still in buying mode when I have a property and can buy. The thing preventing me from buying more aggressively right now is my time constraints. So I'm still a buyer, but I don't buy anything that I'm not planning on owning for at least 10 years. And I think that if you're buying for much less than that, it's a little bit more speculative and there is some risk. When you buy long-term, that's where the value of real estate comes from. So inflation is something that, so when governments get over indebted, they have a couple of different ways they can pay it off. One is to increase taxes, and even if they doubled taxes, it would take decades to pay off how much debt we have, and it would crush the economy, so it's not workable. Or they could cut services in half, so they could shut down every hospital, lay off every second nurse and doctor across the country. They could do that for a while. Also not going to happen. The other way to do it, which governments always pick, is to inflate it away. They devalue money. So when the government prints 30% more currency, it's essentially 30% inflation. They devalue money by 30%. They've essentially printed 30% more money, but what they've actually done is paid off 30% of their debt without actually having to pay off a nickel. So that's why governments like inflation. The problem, the only time they don't like it is when they get in trouble for it, which is they got way too carried away over the last few years, printing money, saying, look at all the money we're helping and supporting Canadians, but they were really just printing money and make rising costs for Canadians. So the problem comes when people start noticing and they got way overboard on it. So they're still going to do it. They just have to lower it from 8 to, they'll call it 2, but it's going to be 4 to 5%, and they're just going to call it 2.5% because of the way they manipulate and look at the numbers. I don't know if you guys have ever looked into how they count inflation and the way they distort the numbers. Inflation can easily be 4 to 5% from what we see and what we pay for things, and they'll be calling it 2.5%. And that's good if you're a multimillionaire. So if you're rich, that's a good thing. Right? There's the biggest transfer of wealth in all Western economies from the poor and middle class to the rich has happened over the last 4 or 5 years because of inflation, because wealthy people can buy big assets and they usually use leverage to do it. So they buy an asset with the leverage they used, and then the money they borrow gets devalued. If you weren't born with a couple $100 million, then you can do that with real estate. So that's one of the things that most successful real estate investors don't even really understand how it's happening. They just call it appreciation, and technically the numbers work. So if you just say, I'm going to count 2 or 3% appreciation on my real estate, it's an easy way to calculate the numbers out accurately. But what's really happening, so the house isn't growing 30%, the value of it's growing, but it doesn't actually necessarily have more purchasing power. If everything's gone up 30% and you sold your house, you could still buy the same amount of jugs of milk or the same minimum wage or the same, like inflation just raises the numerical value of everything. But what doesn't get to go up with it is the debt, because inflation increases the value of assets and what we call everything, but it actually decreases the value of money, but debt is denominated in money. So if inflation doubles the value of your house, numerically, even though the house has no more purchasing power, the debt that you purchased with it is now cut in half. So that's what's actually happening. So you now have if you bought a house for 400, it's now worth 800, but now your mortgage is still at that 400 if you got 100% financing. So in real terms, you actually have $200,000 to pay back to the bank. You're paying the bank back in devalued money. And again, easier to calculate by just calling it appreciation, but what's actually happening is the devaluing of the money you used to borrow it. So if you just buy a house with cash, it's inflation proof, but it's not enhanced by inflation. If you just buy raw land, same thing. It'll go up with inflation, but it doesn't have any extra value. You ought to be able to borrow it, but then have somebody else pay for the cost of borrowing, the interest rate, which is what the rent is for. So when the reason this is important, it's a little bit it's like, why don't we just call it appreciation, then it's easier to understand, is because when you understand it's actually the devaluing of money that you've borrowed to buy the assets with, that's where you get, that's why I'm so comfortable all the time in real estate, because I know our governments are over indebted. They can't pay off the debt. They have to inflate it away, which means they're going to be inflating away. They're devaluing money, which means they'll devalue all the mortgages. My houses eventually will be twice what I paid for them. Some of them already are, the first ones I bought, but most they'll double. Now, none of them are going to grow. None of them are going to get any bigger. None of them will actually have any more. If I sold them, I couldn't buy more meals out, because what I paid at a restaurant, if you've gone out recently, you know that you pay twice as much as you did even a decade ago going out to a restaurant. So the purchasing power of your asset or your house hasn't gone up, but the debt that you owe against that has gone down. So just as governments deflate the value of the money that you've borrowed to buy assets, that's where the wealth creation happens in real estate. You don't even have to understand this. Most people don't. They just call it appreciation. Why I like to talk about it is because no matter what happens, we know inflation's coming. The government cannot afford deflation, because that means their debt burden increases. So they will continue to print money to pay off the debt. Basically, it just makes it easier to pay off debt. They print more money, the value of wages goes up, the value of goods, so GST, their GST take goes up, their income taxes go up. They just continue to collect more and more money without actually technically raising taxes. They're getting more tax revenue. So we're lining ourselves up with the government, basically saying that the necessity that they need, which is inflation, actually benefits us. So that's all right. You've probably heard from me before, and I'll say it again. It's kind of a weird explanation of something that doesn't really require an explanation. The reason I talk about it is because, again, the government needs inflation. So when we're in real estate, the inflation really works well for us. All right, any questions?
Well, thank you. We can see that the business with condos is not attractive, no like detached and single house for the next 2 years maybe.
Sorry, what's the?
So the question is just a comment that the business for condo is not that attractive for the next 2 years.
So like, is buying a condo a good idea for the next 2 years?
Right.
Well, if you ask me, the answer is always no to the first part of that sentence. I don't like condos. Yeah. However, in terms of real estate, no, it's like it's kind of like dollar cost average. Like I don't think we're going to have a 20% appreciation in real estate next year, but it's still a good time to buy. Like if you try and time the market, because people were trying to do this was it end of 2022, early 23, people were like, oh, Toronto's crashed, Calgary's going to crash. And the market softened up kind of into the fall and over the Christmas. And everyone was like, oh, I'm waiting for the market to turn. And they were like, no, I'm not going to buy this house, negotiate, back it away out of a house at 590. And then they're like, okay, now I think I'm hearing that the market's turning. And it's like, no, you've heard that the market turned. That same house already sold for 645. Like by the time you could recognize that the market's turning, it's turned. So number one, but also you shouldn't be buying real estate if you're worried about what's going to happen in the next year and a half, 2 years. It's a long-term play. You want to build a portfolio of really good properties.
Unless you're doing flips, unless you're doing some shorter term strategy, then you really do need to know what's happening in the next 6-12 months. But if you're a long-term buy and hold investor, it's more important what's happening fundamentally on a longer-term horizon than it is the next year or two, right?
Yes. When you analyze Calgary versus Canada, there was an additional detail to compare the surround area for Calgary, Cochrane, Airdrie, versus Calgary.
Yeah, obviously we didn't break down in details, but any area that's part of the CMA typically benefits from the same economic growth that Calgary is benefiting from.
Okay.
But those markets are different, right? Okotoks, for example, has much lower rental supply than some of the other areas have. Airdrie has had fast population growth, but also has rental inventory growth. So all these markets are different, and more so within Calgary, different neighborhoods are also different.
Got it.
Right, so it's big picture, but locally there's differences.
A good example of some of the inner city neighborhoods. I can speak to Bowness because I've got a few properties there. They've had a lot of MLI Select projects in that neighborhood, and problem is now there's a ton of basement suites. So I have a bunch of older properties there, but when I'm trying to rent there, I'm looking at all the competition. It's a ton of one-bedroom suites, so now I have competition there. But it's a localized issue because if I look, just slightly north to some of the newer communities, right, it's not quite the same issue. Like they do have a lot of basement suites as well, but it's not quite to the same extent, and they're not all hitting the market at the same time, right? So,
good.
Yeah.
Okay. Thank you.
Real estate is local. So,
Question.
Yeah.
So based on what you've heard, the population is going down, interest rates.
Sorry, no, the population is not going down.
The fork, yeah. The government's target is technically slightly negative now.
Nationally.
We don't think it's actually going to be negative, but that's the target from the government.
And that's international migration, and that's a net number. So, for example, in central Canada, they have to drastically reduce the amount of student visas they're giving out. Alberta's been allocated a 30% increase for student visas. So because we didn't have any of those, so it was basically storefront, like a 300 square foot strip mall had 10,000 international students in it. It was like an online university, which was just a way to cheat the system and use a student visa to get Canadian citizenship. So they were creating these, we didn't have fake schools basically. So those have all been cut off, but we didn't have those in Alberta. So we actually have a lot of room in our actual universities and colleges to actually international students. So the net number is going to be zero, but in Alberta, we've been allocated to increase the amount of international students. So we still expect more international.
And sorry, I didn't mean to cut your question, but
yeah, it's
the
rest of it. Yeah.
Comparing the overall immigration from 23-24 versus projections. So what I thought is that the immigration is going down, interest rates are going to come down, right? The number of property sales per year are kind of coming down. Inventory is increasing.
Yeah.
And the rental rates are also dropping. So why are the property prices increasing by?
So they're not. So year over year they have, but month over month they're not. Now obviously the seasonality to that, but the market has been balanced over the last few months, and it was a buyer's market previously. So the market is cooling down, and it is reacting to that. And I think it will continue to do so. Next year, we're forecasting somewhat of a 2025. Yeah, this year we're forecasting mostly of a flat market. Flat meaning not necessarily zero, but call it within plus or minus 3 to 5%, like a few percent point. Yeah, I don't think we're going to see anything like we've seen over the last few years in terms of growth. There's just nothing that's supporting that, as you've alluded. So,
and to put context around that from a longer term perspective, the property that my best property is a house that I've got 2 oversized garages on it. It's a great location to always easy rent, central, great basement suite, three bedroom main floor, 2 basement. It's always had good parking. It's got a great yard deck on it, like across the street from a park. So it's my best property, and I overpaid for it. I paid $412,000 for it. Now, if I would have tried to time the market, I might have got this. I would have got that house. But assuming it did sell 6 months later, 8 months later, or a year later, I might have been able to pick that up for $398 versus $412. It's like I don't care. It's worth $750 today, and it's been the easiest property for me to rent for a long time. I would love to overpay by 5% and have all my properties perform as well as that one. So in a long-term perspective, it doesn't matter. Like if you look back at a house that you bought 30 years ago, would it matter if you paid $112 for it or $113.5 for it? It just wouldn't matter if it was a really good property long-term. So, when you're buying from a long-term perspective, focus on building a portfolio of awesome properties that perform really well versus trying to time the market in the exact timing. Again, unless you're flipping, then it's solely important to make sure you time the market and get a killer deal on every property you buy. I know you had another question there too, sorry.
The other one was that, is there a percentage in the percentage of inventory that we have where it would kind of start, we can see a negative impact on the purchase price of the property? For example, if
so we have already, like I was saying, it has started to cool down from the higher inventory.
Inventory is going up.
That being said, inventory is not always 100% correlated to prices coming down. It's usually correlated to a market cooling off, right? So longer days on market and balancing out. But we've seen this before in the last downturn, 2015, 2016. If you exclude condos, but mostly in the single family space, prices did not come down a whole lot, but they stayed flat, which means they were technically coming down because adjusted for inflation, those prices were lower. So I think it's more the kind of scenario we'll see is that adjusted for inflation especially, we're likely going to see price reduction, but it might not be in numerical numbers.
Thank you.
This is a two-folded question. So I wonder, based on the experience in investing, if we focus on Calgary, which areas, communities are the most profitable, like have performed best? And the other is, what criteria did you use when you plan your investment? So
I think the second one's a better question to answer because the first one is very individual, right? It depends what type of properties you're trying to buy, what's your budget, and all these things. But the second point I think is easier to answer. You have to go with your own goals, right? You have to go with your own goals, but you have to think not as a home buyer. You have to think as an investor. So you have to think of what's going to be your tenant profile, what amenities are around there, what kind of demographic is in the area. Grouping your properties so that you're not driving around the city too. So just so everyone can hear the questions were, is there good neighborhoods? And then the follow-up question was, what kind of parameters do you use when deciding on your questions? So, but there's general themes, right? Ideally, you want to look for an area that doesn't have a super high rental inventory, at least comparable to other areas, right? But that still has the demand. Again, it's the supply demand. So if you go in a neighborhood that's got 500 basement suites for rent, and you're trying to build a basement suite that looks the same as all those other ones are, it's going to be tough to rent, right? So it's those kind of things you want to look for.
I would have one thing that I would say, and you've heard me say this before, new neighborhoods are bad rental neighborhoods.
Generally,
they don't have good transit. You're competing with both regular buyers and sellers, but also what the builder does. And quite often, especially after an expansion or a boom, is the builder is getting huge profit margins. So they have a lot of room to cut back the price. So if you go buy a new build in a basement with a basement suite in a new neighborhood off a builder, a year and a half later, they're just building 6 blocks up, but they're building your identical house, still has the same name, and now they're selling it for $50,000 less. Well, that's a cap now on your price. So you're competing with other sellers potentially in the neighborhood, like every neighborhood, plus the builder. The builder can not only go through their profit margins, they could get to a point where they're like, you know what, we've spent so much money on building the roads and services, and we use debt money to finance that. We have to stop the bleeding. So they might even sell at a loss to stop the bleeding, depending on how bad things get. So in new neighborhoods, you have that risk, but also they're not great for, like, sometimes if you are in Seton and you happen to work in Bowness or somewhere else in the city, your transit options are really limited. If you're in Highland Park or Glenmorgan or Acadia, you're really close to a bunch of different transit options, as well as just the employment around you. So you're just going to have, and then there's no builder kind of skewing the market. So if anything,
now it's changing with infills.
Yeah, it is. Yeah, now it's changing with the
But we'd
MLI
be
Select,
happy to chat one-on-one too and see what would be a good fit.
I'd just like to maybe want to try something.
For sure.
Yeah.
Personally, I have a property in Seton.
Yeah.
It's a stacked townhouse.
Yeah.
It's like 5 minutes walk to the South campus.
Yeah.
But in that neighborhood, for whatever reason, I don't know what they're trying to achieve there. There's a whole lot of new construction going on in that area.
Yeah.
That it's gonna be almost, it's gonna be crazy to rent.
Yeah, we've been warning people for a few years now because we've seen this coming, that the equation of supply demand would shift, because Seaton's a great example because fundamentally it does have a lot of good things, right? There's a hospital right there, great source of employment. It's an attractive neighborhood, there's recreational, there's a bunch of amenities, and there is demand, but the supply is just completely outpaces that demand. At least for now, that's what we see.
The funny thing is, during the peak, they marketed Seton as the second downtown of Calgary. So, and I just can't see that happening.
Yeah, a sub-community,
Yeah. It's always supply and demand, right? People will often forget about the demand part or the supply part. It's the two together. One or the other individual, that doesn't really matter. So, but yeah, we can cover that further. Yeah.
Thank you.
Yeah.
Yes?
So I have two questions. The first one's like, I have this feeling that there are a lot of people on the sidelines to Kaneohe because the fixed rate still haven't come down that much. Also, with the economic like news, right, about Canada and inflation and all that stuff, I think a lot of people are kind of afraid of moving. And in their mortgages also have like a very low interest rate. So I don't know if you guys have the same feeling with that part. And the second question is about the zoning. Like the change for RCG, and it seems that there are a lot of complaints now, and there is like some sort of like lawsuit or something like going on. So I don't know if you guys see that also for the change in practice, something as a risk or something like that.
So I can answer about the lawsuit part because I was actually just reading about it, but it was actually ruled in favor of the city to uphold the blanket rezoning. But they're considering appealing the case, but who knows? But as of now, the judge sided with the city.
I think
the
the saying
zoning doesn't change all that. The zoning change doesn't change all that much in supply, by the way, because the projects that are being built with the RCG rezoning were already being approved before the blanket rezoning. The only difference is the developer had to apply to get it rezoned, but at the end of the day, the city was approving pretty much all of them. So it's speeding up the process and it's making it a bit cheaper for the developer. But I don't think it's really adding a whole lot more supply than if the city didn't rezone. So, and yeah, your first part, there are people on the sideline for sure.
So repeat the question. So right? just
to repeat the question, if those people waiting on the sideline, right? That's what you were asking. With the rates still coming down, and some of the uncertainty. There are people that have been waiting on the sideline. That being said, the fixed rates essentially, you can speak more to this, but they're pretty much getting close to.
Yeah, I'd say I've been saying for a while, I think the fixed rates have reached, I would consider a natural bottom where, and you can see that in the bond market, the bond market hasn't moved, even amongst the biggest drops in the variable rates, the bond market, we should have had an overlapping chart, but the bond markets haven't moved, and that's what fixed rates are based on. And I mean, largely, rates in the fours are considered pretty low interest rates historically. Over, if you go back 15 years, prior to 15 years, there was no such thing as rates in the fours. It had never been that low before. So we are, this is probably what's considered a natural bottom. There's also a few different bond investors are actually investors, big sovereign wealth funds buying bonds for a return. They're now associating a little bit of risk with mortgages, which fair enough. We're all starting to see that there's some risk in mortgages, even in Toronto. It doesn't always go up. And then also there's a bit of a currency risk in Canada. Well, there's a bit of a currency risk in anywhere but the US. So we're just likely going to see, that the bond market just may have hit a natural bottom, and there's also just less money to go into the bond market. So it's probably hit, again, a natural bottom. However, that doesn't mean that the Bank of Canada doesn't start participating and buying in the bond market, which they did during COVID. And I suspect there's a possibility they might do it again, because I still am guessing, and I have no other economists are saying that. I mean, you might find the odd one saying it, but I just think things are going to be worse just because, and maybe just because I understand how much of the mortgages may be a little bit more intricately, because I have clients in Toronto. I know what they've been doing for the last 10 years, constantly overspending and then just using their equity every time they move up houses every 2.5 years. I've watched them do it, and now I'm watching them with all that debt, not being able to make payments, and their mortgage rates haven't reset yet. They're in trouble, but that's not an uncommon scenario in a market that there's at least 50% of the people with mortgages have never seen a market that's gone backwards. Their version of a recession was in the financial crisis, where they had a couple of quarters in a row where real estate prices didn't go up 10%. Like they're a small stall is what they consider a recession. So this is all new to them, and there's still a lot of them saying, "Oh, now it's going to recover. Now it's going to recover. Now it's going to recover. Rates are going to come down a bit. Now there's going to be a boom in prices." I'm thinking that again, real estate. You're right. People are sitting on the sidelines because they're hearing economic news, because economists and columnists all just munch the data together. And if you're the Bank of Canada governor, you have to do that to decide what rates are going to be. But when you're investing in real estate, you're not investing in a house that spans Canada. You're investing in a house in a particular area.
Well, don't forget that we're adding supply to, including in the multifamily space, right? So as those people come off the sideline, I don't think there's as many as is portrayed, but even as those come back in the market, they'll have more options to purchase. So.
Yeah, there's nothing. Sometimes people say, well, if it's harder to qualify, if it's harder to buy, then they'll fill up the multifamily. And it's like, well, then whatever they were going to buy is going to end up on the market. It's ultimately household formations, the chart that I think Santhosh talked about, the household formations compared to completions, and we got to add to that the under construction properties as well.